Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? Hope you're having a great day here so far. We're financial advisors. We just try to help in any way possible to help you grow your net worth. Typically, you got to be wealthy, working with Goldman Sachs or something like that in order to get the type of help to grow your net worth, make sure your investments are on the right track, you're getting every possible advantage. Well, we decided we're going to try to make that available to everybody. So if you're interested, go to jazzwealth.com. End of sales pitch. Let's get started today. I've got a couple things I want you to keep in mind with the traditional IRA, and this is mostly geared towards the beginners today. I get these questions a lot. I want to make sure you guys are all updated and know what to expect. With the traditional IRA, there are many differences. Of course, most of you know the main difference between a traditional IRA and a Roth IRA is pre-tax and post-tax. In a Roth IRA, you've already paid the taxes, so any growth or any money you add will not be taxed at all, right? So it's kind of a beautiful vehicle. In a traditional IRA, you're getting that tax deduction ahead of time. You're going to be expected to pay taxes in retirement. You have to weigh the pros and cons and see what may be beneficial towards you. So over here we have the IRA, right? We're going to focus on that one today. Over here we have the Roth IRA. We offer both of those here at Jazz Wealth, and we can help you kind of decide which one's better for you if you're just getting started. Now, in a traditional IRA, you may want that tax deduction. You may make some amount of money, maybe self-employed, who knows what you do, that you need that tax deduction. So if you put up to $6,000 this year, if you're under the age of 50, or $7,000 if you're over the age of 50, you may want to use that on your taxes and try to get some kind of deduction. But unfortunately, a lot of you have been disappointed here because there's an income limit, right? If you make too much and you have a 401k at work, well, you're going to be a little disappointed because you may not get the full $6,000 of a tax deduction. This makes it a little hairy here, but we can help you with it. We help all of our customers with it. So I just wanted to cover a few things real quick. If you're married, right, and you're filing jointly, we'll say married joint, right? You have a traditional IRA, and you also have a 401k at work. Now, this doesn't mean that you participate, right? If you just have this available to you, then that counts, right? If you choose not to participate, the IRS doesn't care. But here's the thing. If your modified adjusted gross income, that's the bottom line number, if your income as a family is over $103,000, that's where you start to see that cutoff, right? Where you don't get the full deduction out of what you put into your traditional IRA. They start phasing you out. And if your modified adjusted gross income is over $123,000, you actually get zero deduction in your tax for making the traditional IRA contribution. Now it's linear, right? So the more you make towards the 123, the more you're sort of scaled out. I'm sorry, it's not compounded, it's linear. So if you make like 113, then you're going to be able to put about half. You can put the full amount in your traditional IRA, but you're going to get only half of the deduction. So something to keep in mind if you have a higher income there. Now, it's not a problem, right, since some of this money would be after tax. So let's say out of the $6,000, you put the full $6,000 in, but you find out, oh no, man, we had too high of income, so I can only deduct $3,000, and $3,000 is after tax, right? This is post-tax, right? This is going to be a bigger deal down the road because now you have to keep track of the differences. What's post-tax, what's pre-tax? So you may consider just moving that into a Roth IRA. Now, in a Roth IRA, this $6,000 that you contribute in here, there's no tax deduction, so you don't have to worry. You just can put the money in. It's all post-tax anyways, so it doesn't really matter. In a Roth IRA, the only income limit is if you make too much money, you can't contribute directly to it. There's no tax deduction or nothing to worry about there, but if you're married, filing jointly again, right, and this time your income, modified adjusted gross income, is over $193,000, right? This is where some people get a little tripped up here. If your modified adjusted gross income is over $193,000, now you start getting phased out from the contribution, not the tax deduction. If you go over $203,000, now you just can't contribute to the Roth in that year. It doesn't mean they take it away from you. It doesn't mean somehow you're blacklisted and you can't do it. It just means you just can't contribute that year. If you did make contributions, we just have to fix it. That's it. You're not in any trouble. We could just fix it, no problem. So that's the big difference. And this question comes up a whole lot because people go, well, shoot, how do I know what to do? Which one's going where? Bottom line is, take a guesstimate as to what you think your modified adjusted gross income will be. Bottom number. It's not your salary. It's that bottom number on your tax return. And take a look and see, does it make sense for you to go all in on the traditional IRA, get the full tax deduction, or do you just make too much? Good problem to have, right? Nobody has a problem with making too much money, but maybe you don't get a tax deduction anyways. If you did not get the tax deduction and you put money in a traditional IRA, let's work together. Let's fix that. Let's get the money to a Roth so that there's no confusion in the future. You can still keep the traditional IRA and have the Roth. The investments inside of them can be the same, but maybe some years you make less and you want the tax deduction, you could put money over here. Let's keep them separate though. That's a big one for me because it just gets to be a little bit of a nightmare if the money is in there post-tax but starts to grow earnings. Now we've got to do some math, and it's a little bit of homework, and who likes homework? Nobody likes homework. Well, I hope this helps you out in some way, and if it does, maybe you'll hit the subscribe button. If I mess something up, bash me in the comment section. I deserve it. But if it helps you in some way, check us out at jazzwealth.com. We're here to help you. Also, 5 o'clock later today, we do the closing beat show. Basically, it's just a stock market update. We cover what's happening in the markets, the good, the bad, and the ugly. We have a little fun with it as well. I always try to share some interesting stats and things that may help you become a better investor to help you get your dough straight. Enjoy the rest of your day. Maybe we'll see you later. Talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.